Welcome everyone. Are you thinking about buying a home or curious about the current housing market? Well, you're in the right place. Today we dive into the heart of the housing crisis that's gripping America right now. Imagine this. You're ready to buy your dream home, but the prices are skyrocketing. Mortgage rates are going through the roof, and there aren't enough houses to go around. It's a wild ride, and it seems like there's no end in sight. But don't worry, I've got you covered. In this video, we'll unravel why buying a house has become so tough, explore the impact of soaring mortgage rates, and uncover the hidden forces driving these changes. We'll also talk about the crucial decisions you need to make, whether you're looking to buy, sell, or just understand the market better. I'll share real-life examples and stories to make this complex topic easy to grasp. Plus, I have some tips and advice that could save you money and stress in the long run. Whether you're a first-time homebuyer, a seasoned investor, or just curious about the market, there's something here for you. So, grab a coffee, get comfortable, like this video, subscribe, and stick around till the end. You won't want to miss the insights and strategies that could make all the difference in your home buying journey. Let's get started. Home buyers are in a really difficult spot right now. Both house prices and mortgage rates are higher than ever, which is pretty crazy. Imagine trying to buy a house when there just aren't enough available. In fact, the US is short by about 4.5 million homes, making it very hard for many families to afford a place to live. Recently, mortgage rates saw their biggest increase in 2 months, jumping back over 7% after 3 weeks of going down. The 30-year mortgage rate is now at 7.03%, up from 6.93%. Even the rates for bigger loans, called jumbo loans, went up to 7.11% from 7.04%. This rise is causing fewer people to apply for mortgages. In the week ending June 28th, the number of mortgage applications fell by 2.6%, and both the purchase and refinance indexes dropped too. Right now, the best advice is to look for a good rental in your area and live within your means. Maybe even spend less on housing than you normally would. This is a smart move. If you find a great deal on a house and can afford it, that's fantastic. But remember, if home prices are at an all-time high, your property taxes and homeowners insurance will also be very high because you need to insure the full value of the home. So, if you can find a hidden gem in the market and plan to refinance in a year or so, go for it. But for most people, it's wiser to be careful. Live a bit below your means, save up, and maybe rent for now. This way you can save the money you would have to spend on a high mortgage payment. As the Fed rates are expected to drop a bit below 7% by the end of the year, you'll be glad you saved. I feel unsure about this advice. You know why? Because I believe that the moment rates drop, a lot could change. For instance, what are the chances of Trump becoming president again? Are you at 70%? I'm at 75%. Let's just say it's going to be an interesting time ahead. What's the chance that with Trump's policies the market will react well? Are the Trump tax cuts going to continue? Yes, they're likely to be renewed and not expire. What about the Fed interest rates? Do you think he'll bring optimism there? Yes, I believe so. We might see rates at 6.75% by the end of this year, and mid-5% next year, maybe even 5.5%. So how does it work? When rates go up, prices usually go down, right? And when rates go down, prices usually go up. But right now, rates are going up and prices are also going up because there aren't enough homes for sale. If rates drop next year, what happens to prices? In theory, prices should go up because more people will want to buy homes. However, American consumers have more debt now than in the last 32 years. If the rates drop, people will start buying homes, but with limited options available, prices might go up even more in better markets. But we need to be careful here. Here's what I've learned over the past 4 years, especially during the COVID era. Many things are unpredictable. Whether you choose to buy a house or not, be ready for the risks on both sides. Some believe the stock market might crash, and we can't ignore that possibility with so many strange numbers moving in unpredictable ways. It's a risk you have to consider. If you're an everyday person with a family looking for a house to make memories in for more than 5 to 7 years, you have less to worry about. Even if rates drop in 2 years, you can always refinance. But if you're tired of renting and want to buy a place and keep delaying it, what should you do? Make the decision based on your situation. If you plan to stay in the house for 5 to 7 years, it might be a good move. But if it's just for 1 or 2 years, Definitely not. State Farm has given California a strong warning. They want to raise home insurance rates by 30% for homeowners, 36% for condo owners, and 52% for renters, or they will leave the state. Imagine how embarrassing it would be if they left California. This could affect millions of people and mess up the state's property insurance market, so the state needs to take action. State Farm isn't the only one. Other insurers like Allstate are also making similar moves. These rate changes are due to rising costs and risks. Let's look at some numbers. Over the last 5 years, the cost to rebuild homes has gone up a lot. Since 2019, before COVID, the cost to rebuild a home has increased by 31%. This includes labor, subcontractors, and materials like copper, lumber, and drywall. Insurance companies are facing higher costs when homes are damaged or destroyed. If your house burns down in California, it costs 31% more to rebuild it now than it did 5 years ago. Part of your insurance payments goes into a pool to cover these rebuild costs. There's also the risk of wildfires. These fires have been partly due to the state's poor management of its relationship with PG&E. The old power lines and lack of proper maintenance caused many of the wildfires in Northern California over the last 3 years. Instead of managing their forests properly, the state let this happen. State Farm is saying they can't afford to cover the increased risk and costs. Living in California has become much more expensive, and the value you're getting for your money has dropped. It all comes down to supply and demand. It will be interesting to see how California and Florida handle this situation. It could get very messy. I'm really curious to see how California will respond to the demand for a 30% increase in rates. That's a lot of money, right? 30% more for your home insurance? It's not because the companies want to profit 30% more. It's just because costs are going up. They're like, what do you expect us to do? What makes insurance costs go up? Things like crime, weather, and theft. Imagine an insurance company saying, I won't insure cars in your community because too many cars get stolen there. When you get auto insurance, they ask questions like, how far do you live from work? How much do you drive? Do you have a garage? Do you live in a gated community? How many miles will you put on the car? These questions are all about risk. Wage growth has slowed to 2.4% annually, and unemployment has ticked up to 3.9%, with labour force participation remaining at 62.7%. Analysts see this cooling as a good sign, providing relief for the Federal Reserve amidst inflation concerns. The report highlights the need for sustainable productivity growth. If productivity grows at 2% and wages at 4%, it can help mitigate inflationary pressures. In simple terms, America, if you have a good job at a solid company with a decent boss, appreciate it. Be thankful for the good people around you and your stable job. Why is this good for inflation? Well, fewer available jobs mean less competition for workers, which keeps wages from rising too quickly. If a worker asks for $25 an hour instead of $23, the employer might agree, but then they'll raise their product prices, leading to inflation. So, if you have a great job, hold on to it. The job market is showing signs of weakness with fewer good full-time jobs and more people taking on second jobs or side hustles. The government even admits they're not capturing all the cash-only side hustles or 1099 gigs, like your mum driving for Uber on the weekends. This is important, especially in an election year. Here's why I think Trump might be the favourite to win the election. In my opinion, he's leading on 2 out of 3 major issues in America: the economy and jobs, and immigration and border security. James Carville famously said, "It's the economy, stupid." Mortgage rates continue to rise, reaching 7.7% this week. This is making the home affordability crisis even worse and stifling the housing market. Freddie Mac's latest survey shows the average rate on a 30-year fixed mortgage jumped to 7.17% this week, up from 6.43% a year ago. The average rate on a 15-year mortgage rose to 6.44% from 6.39% last week, and it was only 5.71% a year ago. When all these factors come together, it's like a hurricane forming in the American housing affordability crisis. Mortgage rates have now risen to around 7.5% for 30-year mortgages, even for people with good credit. This is the reality for those looking to buy a modest home, not luxury properties. If you're in one of these markets and need to sell your house to get some equity, you have to lower your price to match what buyers can afford at a 7.5% interest rate. So supply and demand are coming together. Struggling consumers are trying to sell their houses and have to drop prices to meet buyers' qualifications. We've seen this happen in Austin, and now we're seeing it in parts of Florida. As for the wider United States, I can't make a prediction. Here in South Florida, things are still stable because there's a lot of people and money here, but the trends are starting to show. The most important person for your financial situation right now is Jerome Powell, the chairman of the Federal Reserve. The Fed's decisions significantly impact the economy. If you're wondering why mortgage rates are where they are, you need to look at the Fed funds rate, which is currently 5.5%. This is the rate commercial banks pay to borrow money overnight from the Fed. The prime rate, which customers pay to borrow money from banks, is typically 3% above the Fed funds rate. So the prime rate is sitting at 8.5%. For the average person, if you want to understand mortgage rates, just listen to what the Fed rate is from Jerome Powell and add 2%. That'll give you a good idea of where the mortgage rates are. When is the next rate drop likely? Let's say it might happen in September or October. So this summer could be a good time to buy a house. If you close in August or September, you might find some good deals. People who have been wanting to sell for a while are realizing they can't wait any longer because it doesn't look like rates are dropping soon. If you find this video helpful, please like, share, comment, and subscribe. Here's to your investing success, profitable investing.